Welcome to Acumon Analysis, the show where we discuss the economic, market and political decisions that are impacting you and your business.
Welcome to Acumon Analysis Series 3, and we're with Dylan from SRG, and we're talking this time about different types of fundraising, whether that's debt, equity. We've done a very technical version of that a couple of episodes ago, but this time we're talking about it sort of from the investor's perspective to help you, business owners, understand sort of at what stage you're at and which investment might be best for you. So welcome, Dylan.
Thank you for having me.
I think we're starting off with that very, very fledgling business that might just have an idea and looking at pre-seed money. What's pre-seed money?
I mean, I guess if we take a step back from that even, right? There's two very different types of companies that are looking to raise money. There is a startup company, which is an unproven company, which is basically an idea, and that turns into a scale up. And that's what all of these companies like Stripe have become when they're successful. And then there's conventional businesses, which is your plumbing business, which is your airline, which is your restaurant, cafe, bar, whatever you want to call it, right? Those raising capital for those two different archetypes of businesses are very, very different.
So we're talking about one that's not revenue generating and one that's already got clients.
So the venture space, we call it the venture space. And the venture space is typically, you'll have heard about VCs, venture capital companies. The venture space is where startups typically exist. Again, you can have a startup cafe, but it's very different. A startup is a business that has an unproven business model, typically an unproven market, and you need to effectively start from scratch and convince people that they need something they've never heard of before. And those typically at that pre-seed stage, which means you're pre-revenue, often pre-product, you raise what's called a friends and family round. And a friends and family round is, as it's called, you ask your friends and family for some money. And that money is to fund normally the initial build, if it's technology, or some marketing if it's already built. The stage after that is seed, which is you've got a bit of proof points. So you've got a bit of customer acquisition. You might have some revenue, not necessarily have revenue always. And that round, typically I've seen raise up to about £25 million valuations. So you will be raising capital, you know, between a couple of 100K and a few million for a particular growth thesis.
This is where the valuations are really tricky, because it's very hypothetical.
Yep.
It's very much based on, expected or hoped for market share and stuff like that.
Yeah, so this is the complexities. When you're valuing one of these businesses, it's typically valued on market potential. So if you're inventing some new way of brushing your teeth, as an example, you'll say that, well, the market right now for toothpaste or toothbrushes is this much, and therefore we think we can capture this percentage of it, and we think that we can do it by this year, so therefore it's worth this much revenue, so therefore we'll call it worth this much. For lack of wasting everyone's time here, most of these valuations are absolute nonsense. Absolute nonsense. So good luck. You just got to convince your investors that it's going to make them money.
I think the valuation for any business is often, how much is someone willing to pay for it at the end of the day?
Yeah.
You could say that this industry goes for multiples of this EBITDA, for an established business or whatever. But if you can't find a buyer or an investor who's willing to do that, and you've got to drop the price, well, guess what? That's all it's worth.
Yeah, absolutely. So it's a really, really hard job when you're at the startup stage raising capital, because you've got to convince somebody that it's going to work, even though it's still very high risk. You've then got to make the thing. If it's a technology or a product, you've got to physically make it and make sure it works, and you've got to deliver it. So, in a conventional business, it's, well, I already have this product or I have this service. I'm a qualified accountant, therefore I can start an accounting firm. Great. Your biggest issue is then finding a customer and delivering. In the startup world, there's like to build the thing, make sure it doesn't break, find the customer, deliver it, raise capital. It's a very, very difficult job. Typically, once you've passed what they call critical mass, where you've got all these customers acquired, you've got all the proof points, you get to Series A and beyond. And this is just a very fancy way of saying you're now big, you're established, and you're raising a further round. So Series A just means I'm raising a round after seed, Series B after Series A, etc. The number one goal in those things typically is to either IPO or exit with a trade sale. And a trade sale is basically when you sell to another company, typically a competitor.
And what kind of investors are we looking at for this kind of round? What are the investors looking for?
So family offices, so high net worth individuals who've pulled their money into a more institutional fund. Some institutions, so venture capital companies, I think SoftBank or Octopus in the UK. And then some private equity do invest in startups and venture, but less so. And then governments often back things even at that level if they're strategic. So if they perhaps a defense adjacent thing or energy adjacent, they'll pump money. And governments may, so I'm not saying HMRC comes along with a check. What I'm saying is that the government will have a fund of some sort it puts money into, which allocates money in there. Again, one of the startups I'm involved with has just done that. We've closed £3 million from effectively the government. And as you get bigger, it gets easier.
Yeah. And before we move on to any other rounds, I think it'd be worthwhile, especially for UK businesses, just mentioning some of the special status you can get on some of your shares. When you're sort of pre-seed, seed level, there's this thing called SEIS, which stands for Seed Enterprise Investment Scheme, which basically means that your investors can get 80% income tax relief, which is, hugely improving return on investment, assuming it all goes well, but at least de-risking it. And then going on from there, so your Series A, that's the stage where you might get EIS, which stands for Enterprise Investment Scheme, where you can get 30% income tax relief. Again, not quite as good as the SEIS, but then you're taking less risk. It's a little bit more established. So this is a HMRC approved and created scheme to promote investment in the UK.
Yeah. And signing up for those is pretty straightforward. And leveraging them is a huge part of the sales pitch, because I'm going to go, Edmund, if you invest in my startup, you can write off some of your income tax. And by the way, if my startup fails, it costs you effectively nothing. But the downside is...
I think I mean, it's 80%, not 100%.
Effectively, right. There's very few investments in this country where you can do something like this.
True, that's true. It is high risk investment often because it's a startup, but you're right, it's better than a high risk startup over here that doesn't have it, for example.
Yeah.
And I think the other thing is if you've recently sold some assets and you've got a capital gain tax issue, you can actually roll that gain into these investments as well. So there's another angle there for some tax saving if you're a high net worth.
Definitely. So I think moving on to the other types of investment a business can get. So startups typically find it much harder to get debt capital. Debt capital being, hey, I'm going to give you 100K, but I want to get paid 6, 7, 8% interest a year, whatever it is. It's very difficult to do that because, again, startups aren't always revenue generating. They're almost never profitable. Uber only recently became profitable as an example.
And the reason why is because a lender's only looking at downside risk. They don't get the upside if it goes and gets IPO'd. They only get capped at their interest. Yeah. So for them, they're always saying to themselves, well, how could it go wrong?
Yeah.
And if it goes wrong, how do I get my money? Which is why they love, being able to touch their assets.
Yeah. But I think the important thing here is everything is very different depending on the type of company you're raising capital for. So let's take two very similar businesses which are early stage. Let's take the toothbrush example. I have a idea to replace toothbrushes with some different thing, maybe a chewable or whatever. I now have to invent that thing, prove it works, get it regulated, blah, blah, blah. That's very high risk. So somebody investing in that business is going to be quite complex. Let's take option B. I'm buying a cafe, or I'm starting a cafe. Not a lot to prove there besides demand. Cafes are pretty straightforward. Coffee costs. People have been selling coffee for forever, effectively, right? So it's very, very straightforward to raise capital for that, because me as an investor will understand based on demand and the right marketing spend, you're going to get this customer. So investors in this type of business, established businesses or more conventional style businesses, are going to come at it with a very, very different risk appetite and angle. Now, early stage businesses that are conventional aren't necessarily going to be able to get debt capital, especially in the UK. It's very difficult. In the US, it's a very, very different story. But when we're looking at larger, more established businesses, let's say that cafe was actually a chain. It had 4 cafes and it was doing £5 million a year turnover, which is a lot for a cafe, but let's say it was. And you've got that track record, you can go to a broker or a NatWest and you can get debt financing with a specific need for growth. But again, you have to have that narrative and story there as to what it's going to be for.
Yeah, absolutely. And you need to make it easy for them to say yes, lay out the whole thing, all the assumptions.
Yeah.
We've talked about this previously, haven't we? It's very easy to sort of assume that the person that you're pitching to, whether it's a lender or an investor, sort of knows and understands your business model and understands why it's fantastic sort of market to be investing in and growing in and all the rest of it. But at the end of the day, they might only know a handful of sectors over here and have never dealt with toothbrushes or...
So I'll give you a perfect example. The company I've recently been working with is effectively a value-added reseller, and they have recently acquired a manufacturing business, and they went out to raise money, both options, debt, equity, convertible loan notes, all of it, to try and push through the standing up of this manufacturing facility and the growth of it. And the challenge they went through with that process was that in their narrative, they didn't really explain the connection between them as a value-added reseller and the manufacturing, that actually we can sell everything this factory makes and more through this VAR and not pay commissions. So our margins are effectively double what competitors are. But nowhere in the deck did it have a headline going, this is what the story is. Nowhere in the deck did it talk about that. What it talked about was hypothetical IRRs and things like that. So you go back to the most simple thing, which is let's make it as easy as possible for investors to understand what they're looking for, whether they're a bank, an individual, or a fund. And let's make it really, really simple for them to gather the right information.
Yeah, no, literally got to assume they know nothing. Assume they know nothing, lay out all the assumptions, almost treat them like, a child that needs to have everything explained. Absolutely. And I think, another thing we've been talking about, because it's a service we provide, forecasting and all the rest of it. If you can't put a forecast in your deck to show how you can afford repayments if it's debt, or how you're going to grow the business and achieve X times more EBITDA for your PE investor or whoever it is, you're not going to be able to entice them in. You're not going to be able to get them to say yes easily. They're going to have to quiz you and quiz you and quiz you. And these are guys that get hundreds of deals across their desk, whether it's lenders or investors. They get hundreds of deals across their desk every week. And if you're not making it an easy yes, the next one that he looks at might be, and you're just going to lose out basically.
Yeah, actually, that goes back. That brings me on to a pretty important point, which is asking for investor feedback.
Absolutely.
Now, banks may not give you explicit feedback because they're banks and they're thousands of years behind and they're going to get replaced. I truly believe the banking system in the UK is going to have to change significantly to catch up with the US and Asia. But if you don't ask your investors for feedback as to why they didn't invest, how do you know how to improve? It's almost like asking for reviews as a business. Why don't you ask somebody, hey, would you have 5 minutes to hop on the phone and explain why? I'm not trying to convince you otherwise. I just want to know, brutally honest, hurt my feelings, break my heart. What could have been different? Why did you say no? And there's two reasons why that's important. One is you need to know, because if you get feedback from all the investors and they actually go ahead and say, actually, correlation says that this isn't going to be investable, then you need to go back to drawing board. But the second reason is if you can then go back to them in 6 months and say, I took your feedback, we changed these things,
and now we're where you want us to be.
Now we're ready. You've got this whole pool of people which you would have written off already as potential future investors. And I think it's really, really important to build those relationships with investors, because you're not going to be raising once typically. You're going to be raising multiple times.
Absolutely, it's right. And I also think that sending a pitch deck's one thing, but getting someone face to face with the person who's passionate about the business sells differently. It comes across differently.
I mean, massively. And also who's doing the pitch is really important. Who's on the other end of the phone, because you have a lot of businesses with great technical founders who are awful salespeople, and raising capital as a sales game. You are basically selling the dream to them.
Absolutely.
So make sure the person you're putting in front of them is great. I mean, I'll give you an analogy. I've got a friend who runs an events business with two of his buddies, very successful company. They make tens of thousands of dollars a night in profit when they put events on, and they do events every week.
Yeah.
Very, very impressive guys. But one of the guys they will never bring to a meeting with organizers, with potential partners, because he's too informal. He'll walk in, people will be like, who's this monkey?
So,
right? But he's actually the ideas guy who makes all the events amazing. But the point is it's not about tracksuits. It's just about how he carries himself. And the point is they've had feedback from people going, hey, don't bring him because he's going to put this guy off. So it's the same with the investment thing. Don't bring your boring technical founder to do the pitch. Bring him in the room so you can answer questions, but have the sales guy sit there and sell the vision.
Absolutely.
Because you need to sell confidence as well as the numbers on the deck.
Yeah, it's true. And actually, I think that's more so with investors as opposed to lenders, because lenders are still, like I said earlier, just looking at downside risk, but investors are a little bit more excited about the potential and a little bit more excited about, what could come of this business down the line.
Yeah, I mean, all the debt-based investors want to know is that can they make repayments?
Can you service
their collateral? Yeah. I think one thing that's really important to cover too is that there's a lot of people who represent multiple investors, and they are not in themselves investors, but they are presented as investors.
Yeah.
So what you don't want to do is you don't want to be spending loads of time speaking with somebody who has what they call they'll call it a fund, a family office. They'll call themselves a high net worth investor, but actually what they are is they are a broker. They're somebody who will go out to all of their contacts and say, hey, have you got this? Have you got that? If you are speaking with this person and you think that they are the investor, you're wasting your time. If they're upfront about who they are and that they have these connections and they've vetted these people and they have allocations, let's be clear. But there's a lot of people I know out there who claim to have funds and there's no allocated capital. Every time they want to invest, they have to go out back to all the investors and get approvals.
Yeah, I've seen less of that and a lot of people who are brokering deals, i.e., they're saying they've got a big bank of people, but actually they've got some people that they barely know that they'll send some pitch decks to, and ultimately you're wasting your time again. But it's really hard out there to find the right people.
It's really hard as a first-time founder or first-time capital raiser to know how to do it, and you've got to have a good partner. One thing I would say is, unless there is a very clear proven track record, never pay somebody a retainer to help you raise money. That is a very much investment banking thing that large companies use. It is not your £5 million turnover business.
Yeah.
That's your 500 million turnover business. Because what happens there is that they will just keep leading you on and they'll be making money either way. It's not the sort of business you want to be spending a retainer on. Now, the different things that you could get help with that you should pay for: good data rooms, good decks, support on calls,
sensitivity analysis, so you know your top end.
Yeah, you need to have all of that clear. And again, if you're a startup, you've got no historical revenue. But if you're a established business looking to raise capital, you need to be showing what your historical performance is. And if your historical performance is crap, what are you valuing your future on? Because nobody invests in potential in established companies. Like if you're an accounting company, they're doing 2 million turnover, 100K EBITDA, hypothetically, are we going to suddenly value them at 25 million pounds because they were undermanaged and they have this niche? Probably not.
Exactly.
Because you're going to invest in them in the multiple that's relevant for that sector.
Exactly.
So they're two very different things. So if you're ever talking with investors or advisors who confuse private equity and venture capital, who don't understand the difference between debt and equity, who don't know about your specific position, I'd run away, because you've got to answer the question: what kind of a company are you? Are you a startup? Are you established? Are you more on the venture side, more on the conventional business side? What do you need the money for? How soon? Right? What's the amount? Because again, that really does dictate who you're going for. And also, how much do you need?
So I suppose the other thing that we haven't spoken about, because all of this is sort of institutionalized stuff. There's VC firms you can go to, the PE firms. There's the high net worth family offices. There's also, some really low hanging fruit sometimes within your own business. Yeah. We've talked time and time again about examples where we've both found people who haven't raised their prices for 5 years. You do a quick increase and it goes straight to the bottom line. Or
you don't have to raise capital. Sometimes you can find the money in your own business if you just sit down and do a quick financial exercise. And again, maybe you're not capable of doing it, but your accountant probably will be, or we can do it for you. But my God, we can find you money. If you want to invest in an app in your business and you haven't gone for R&D tax credits, what the fuck have you done?
Yeah, R&D, and it's amazing how many accountants out there who are doing R&D but don't know about patent box tax relief. That's a really, really awesome scheme. One of the few things the UK is doing right from a tax perspective. If you can get a patentable product or methodology, you can actually get your corporate tax on that particular business line down to 10%.
Yeah. I mean, or you can, again, as you said, price engineer. In the short term, you can find a lot of cash flow. What you said, you had a client recently, you doubled their pricing and no customer attrition happened.
Yeah, I mean, they'd left it for at least 5 years, so it was a bit of a no-brainer. And I think their clients sort of knew that they'd had it really cheap for a long time, and because they'd been treated so well, they were happy to stay. But there was a lot of lost revenue over those years. If you think about all those incremental changes that should have happened when their suppliers were doing it to them.
And actually, that brings me on to actually have an inward look at your business. So don't raise capital because you need money, because you've got a cash flow problem. Actually see if the business in itself is actually profitable and worth investing more money in, and which division of the business is too, because this is one of those situations we call, you're reaching a new stage of growth you haven't been in before. So if you're looking at raising capital, ask yourself why, what's it going to be used for? And also, is it the best use of my time and energy right now? Because I've had lots of people come to me and go, Dylan, I'm looking for this much money. And I'm like, why? And they go, I need growth. Okay, well, why do you need to invest in growth there? It's all because, we've got debt in the business. Okay, why do you have debt in the business? Well, it's because you mismanaged the company. So there's like lots of reasons why your business isn't in the position it needs to be in. And more money isn't necessarily the answer. Think of like a leaking bucket as an analogy here, or as a metaphor.
Plug up the holes first, right? So the other thing, and this is probably beyond the PE funding, in the next stage of things, is IPOing. If you've got a business that's reasonably well established, there's a number of exchanges that have liquidity on them. I've got a number of advisors that help IPO. In fact, one of my clients is working with them right now to IPO probably in the next 12 months or so. And it's very exciting, all that. The exit is going to be at, really good multiples, like it often is. Who's that good for, from your experience?
Well, I've seen a few recent examples of very niche businesses IPOing on some very like non-primary stock exchanges, like some, there's a number of different stock exchanges in London that you can list on.
It's loads, yeah.
Exactly. So like there is an expense to it, it's 100K plus and probably fees and admin stuff to do it, but you can get liquidity into some very strange businesses that way if you build a narrative. So it's not just SpaceX.
Yeah.
Who are, big on the news right now talking about maybe doing that. It is actually smaller businesses too, but I would speak with an advisor about that before doing that, if that's your strategy.
Yeah, look, it's not for everyone. Often you have to be quite well established. There has to be a good rationale for people wanting to buy in and buy shares on the exchange. And, once you've got a broker involved, there's potential for issuing more capital down the line as well. So it can be a good long-term strategy if you need funding more in the future as well. But yeah, definitely seek out an advisor. It's just another option in the arsenal.
Yeah, I mean, I would start like anything. It's a spider web. I would start with what is the ask? And then let's define what kind of a business are you? What kind of capital do you need? How much do you need? Blah, blah, blah.
Yeah.
And go from there. It's like solving any business problem. Let's not solve it in isolation. Let's solve it within the wide remit of the business. And then let's pull in the right people to help make the decision. And again, like get feedback, get no BS feedback from people, have your feelings hurt, because you're better off actually raising the money than trying to raise. I know loads of businesses that have struggled for years to raise capital. There's something wrong if it's taking you years and you've got viable introductions.
Agreed. Yeah. Like we were saying earlier, you need to make it an easy yes. So get your ship in order, plug those holes in that bucket, and then look at your options and probably seek out some advice to see which options are actually suiting you best.
Yeah. And get your finances in order first before you do any of this, because people are going to look, if you're an established business, for historical finances, they're going to have questions. Again, I have tons of companies I've spoken to in the past who want to raise capital or want to sell, and it's just the wrong timing because they don't have their accounts reconciled, believe it or not. They've got debt on the balance sheet, which doesn't look good, senior debt, which means any other lenders are going to have trouble. And because of that, their EBITDA looks terrible.
Yeah.
Not because of that, obviously, but because of just mismanagement of the business. So a lot of the thing is about timing. So get your finances in order, get prepared, because what you don't want to do is in the rush to get that investment or exit, leave millions on the table. And we've seen millions and millions and millions left on the table before by rushing.
Yeah, exactly.
And I'd say last thing I always say on these things, fact check it, research about the person who's advising you on it, ask around. I've seen a lot of people who aren't qualified to advise on business exits, advise on it because they have a big business themselves or because they sold a business once. Just because you sold a business once and made loads of money doesn't mean you know what you're talking about. It's like followers on Instagram. You don't necessarily know how to build a great Instagram page. You can happen upon these things a lot.
Yeah, it's true. So I think that's a lot of food for thought. And we are planning to do a Q&A at some point in the future. So if you've got questions about raising funds at any level in that journey, whether it's debt, equity, whatever, send them across. Go to the Acumon website, send a web inquiry and say this is the Acumon Analysis podcast, and we'll go through them.
Come and have a chat with us, and we can point you in the right direction, put it that way. We can tell you if you're ready, if there's ways to find money in the business itself. But yeah, this is a really, really important thing to listen to today because there's so many different ways to get money, but there's only going to be one or two ways that apply to you in your current position today.
Thanks for joining. Catch you next time.